Good evening friends, welcome to my channel. Today we are going to start with the fourth chapter of economics, that is theories of interest. So this chapter will hardly take half an hour, and if you understand the concept it will help you to remember. Okay, so one more information I would like to give you friends, that if you think of clearing CIB, then you have to be a bit focused. At least 2-3 hours of a study for a month is enough to clear this paper, and try to make your study more experiencing and interesting as possible. Okay, so that will help you to motivate yourself to go on with the chapters. So let's start. So interest. So since the chapter says about the theory of the interest, so it will lead with the interest only. So what is interest? The first question comes in mind, what is interest? When we're in bank, we know interest is a payment made by the borrower for the use of sum of money for a period of time. So interest is what? It's a payment made by the borrower for the use of sum of money. The borrower, they borrow the money, and they borrow the money for a certain period, and they have to give something back in return. So that is their interest. So it is one of the four types of income. The others are rent, wages and profit. So this is important. Okay, so what is interest? Interest is one type of income, and other types of income are rent. Like if you give some if you have a flat and you give in on rent, so you're going to make income through it. As well as the wages which we give to the workers, that is an income. Then the profit. So all these are the four types of income. Now the three elements can be distinguished in interest. So what are the three elements which can be distinguished in interest? One is payment for the risk involved in making the loan. Okay, so what is the risk? There is a risk, like the loan may get default. If the interest is not paid, then the loan may get default. So that is the risk involved over there. Then the payment for the trouble involved, the trouble which you have taken to give the loan, the documents which you have collected from him. So there is a bit of there would be a trouble. And the pure, so we are asking that for what we are taking the interest. So these are the reasons, like payment for the risk involved in making loan, then the payment for the trouble involved, and then the pure interest, that is a payment for the use of money. So as the person is using the money, so therefore for that reason we are taking interest from her or him. Okay, so this is what it is given. You can just give a reading over there. So what it has been said over here, I will tell you in my words. It has been said that therefore it is said that the rate of interest charged by the obviously you have seen in the when the banks were not there in the 60s, what they used to do, the people whenever they want the money, they used to go to the money lenders. Okay, the money lenders, they used to charge high interest rate. Since why it was so, it is said that the rate of interest charged by the money lenders or an unsecured loan will be higher than the rate charged by the bank, because the money lenders, they are not taking anything, document or any collateral as a security. So therefore for that reason they used to charge a lot of interest rate, whereas the bank, they are taking documents, they are taking collaterals. For that reason their interest rate is less than them, who can provide sufficient collateral security. The government offer, it has been said, the government offer high interest rate on a long-term loan than a short-term loan. So the government generally, they offer a higher interest rate on a long-term loan, because for long-term you are taking the loan and than the short-term loan. Then we are moving to the next part, that is Keynes' liquidity theory of rate of interest. So we have came across this name in the first chapter, I think so, Keynes. So J.M. Keynes, as the name given, we have heard of this economist in the first chapter, in the part of macroeconomics, as I could recall. He wrote a book, there also it was written, he wrote a book, that is The General Theory of Employment, Interest and Money. What you have to remember, you have to remember this employment or interest or money, then you will be able to remember the book name. The General Theory of Employment, Interest and Money. And he gave a new concept of the rate of interest. So he came up and he said that rate of interest is purely a monetary phenomena. It is determined by the demand for money and the supply of money. Keynes was there in the macroeconomics also, where it was written that he had written a book of general theory of employment, interest, money, and here he came up and he said that the theory of interest, its rate of interest is purely a monetary phenomena, and it is determined by the demand of money and the supply of money, and therefore it is known as a liquidity preference theory. So J.M. Keynes, what he said the interest is purely a monetary phenomena and it's a liquidity preference theory. His theory is said to be a liquidity preference theory. So what he said in his theory, he said the demand for money is a two-asset economy. The demand of money is a two-asset economy. So what two states about? The two-asset states about there are two motive. What he said, that is, one is transaction motive, another is a speculative motive. So two assets, one is money is in the form of currency deposited in the bank with earned no interest, and long-term bonds. One is the money which you keep in the current deposits. In current account you don't get any interest, that is one type of an asset. Another is if you keep as a long-term bonds, where you can, when you keep for a long-term bonds, you get a high rate of return. So that is how he divided it, the two assets he have divided it. For example, here I would like to say that if the rate of interest, ROI, what I am talking about is the rate of interest which the banks provide. If the bank are providing less interest rate, people will move towards buying bond prices, where they will think of getting more interest rates. So ROI and bond prices are inversely related. Whenever you're studying this part, you have to understand that ROI, the rate of interest in bank, if it decreases, then the people will start investing in share prices, in bonds, in mutual funds, where they will find that they will get more interest rates. So hence it has been said, one understand that the ROI and the bank bond prices are inversely related. Now talking about, we have said that the two asset economy, here he have said there are two parts. One is transaction motive, another is speculative motive. So here it is written, first, the higher the level of the nominal income in a two asset economy, more the money people would want to hold in portfolio balance. This is because of the transaction motive. So transaction purpose is a one purpose for which people will try to hold their money. So once your income is increasing, your transaction motive also increases, okay, and hence the people will try to keep money with them for the transaction purpose. Once the salary increases, the expenditure also increases. So for that reason, the first part is the transaction motive, and the second part, it has been said about this speculative motive. So for our first part, you have got that the higher the level of nominal income, the money they will hold for transaction motive, according to which at a higher level of income, higher the transaction motive they have. And second is the for the speculative motive. Now it has been said that the higher the nominal rate of interest. Nominal rate of interest, here what it has been said, it has been said about the bank interest. Now if the bank interest increases, lower the demand for the money for speculative motive. What do you mean by speculative motive? Speculative motive is like, speculative means the money which you are keeping for higher risky money which is not secured. For example, the money which we invest in mutual funds or which we invest in shares, they are if we keep for a long term period, then only it gives high return, or else it is not so. So that it has been said that if the nominal rate of interest in banks, if the rate of interest is more, then lower the demand of money for speculative motive. Bond rate increases, lower the demand of keeping in the banks. So if we will give a reading, what it has been said that firstly, because the higher nominal rate of interest implies a higher opportunity cost for holding the money. At a high rate of interest, holders of money can earn more income by holding bonds. So here it has been said about the bonds. If the rate of interest is higher, holders of money can earn more income by holding bonds. Obviously, if the bonds are giving more interest rate, they are going to hold bonds instead of money. Secondly, if the current rate of interest is higher than what is expected in the future, the people would like to hold more bonds and less money in the portfolio. So secondly, it has been said, if the current rate of interest is higher than what is expected in the future, the people would like to hold more bonds and less money in the portfolio. Obviously, like they will try to hold the money in the bonds because they are going to earn more interest rate. For that reason, they are holding the money in the bond. That only it has been written again. If the current rate of interest is low, in other words, if the bond prices are currently high, the people will reluctant to hold large quantity of bonds. And it is quite sure the person, if you see that you are getting more interest rate in the bonds, then for sure you are going to invest in that only. So because of the inherent fear of the bond prices would fall in the future causes capital losses to them. What it has been said in this graph, it's a money demand curve graph. Rate of interest in the y-axis and quantity of money in the x-axis. If we try to understand in this way, like if the bond price, if we are keeping in the y-axis and the transaction motive in the x-axis, you can see as the bond price increases, the transaction motive decreases. Hence, the graph will go sloping downwards. That is the money demand curve. That only it has been said over here. Okay, there are two graphs and two slopes has been given, LP1 and LP2. So therefore, there has been rightward shifts towards this LP1 curve, and it has went to LP2. That the ROI in the y-axis and quantity of money in the x-axis, if we keep the bond in the y-axis and the transaction motive in the x-axis, we will get this graph. That only it has been said in this money demand curve. Okay, so determination of the rate of interest equilibrium in the money market. Okay, so in this part a graph has been given. We'll move to the next page. So a graph has been shown where the demand curve LP is the demand curve, MS is the money supply, MS is the money supply curve, which is vertical straight line, as you can see, fixed by the monetary authority. LP is the demand curve. Money market equilibrium is at 10%. E point is a money market equilibrium. So if we see, we have seen 2 points, that is if the ROI goes in 12 and if the ROI comes to 8. So once what happened if the ROI goes to 12, here you can see the money supply in ROI is in 12%. The supply of money exceeds the demand for money. Okay, why is it so? Which shows that there is an excess supply of money in the market, but people don't want to hold money in portfolio as much as the monetary which has been provided by the monetary authority. So they are not holding the money, whereas the monetary authority has kept the supply of money. Whereas when the rate of the interest comes in 8%, which shows that the demand curve, that the demand increases the supply, which means that the bond prices falls. Once the bond prices falls, they will try to keep the money with them. So for that reason, the demand of the money has increased, whereas the money supply is not so much. So they will try to sell off their bonds and they want to keep the money with themselves, as because they can see the rate of interest is decreasing and hence there is of no interest. If it start fall, then they will make a loss. So for that reason, therefore if the rate of interest is at 8%, you can see that the bond prices falls and hence they want to keep more money in speculative purpose. Okay, so they try to sell off the bond to get the money supply more. You could understand well that they try to sell off the bonds for what? To get the money supply more. That only it has been written over here. Whatever I have stated, whatever I have said you just now, that only it has been written over here. You just give a reading, you will be able to understand. Okay. So next part is effect of increase in money supply. So what happens if the money supply moves from MS1 to MS2? That only it has been said in this graph. Effects of increase in money supply, the LP is the demand curve, as you can see, and the money supply has increased from MS1 to MS2. What else we can see? That ON is a quantity of money available, E is the equilibrium point, and OR is the equilibrium rate of interest. So at equilibrium rate of interest, ON is the quantity of money available. Quantity of money available at OR, rate of interest. This is an equilibrium point. Hence money supply is increased. How do you think that the money supply is increased? The money supply is increased by the central bank by buying securities. What they do? They buy securities from open market, which helps in increasing the money supply. So through the open market, the central bank, they buy securities and they provide money in the market. In this way the money supply is increased, and hence we can see what happens once the money supply is increased. When MS1 goes to MS2, the rate of interest is decreasing. Now we are going to see that how the rate of interest is decreasing. From R to R dash, it is reducing. So what happens is that when money supply increases, the rate of interest, once the money supply has increased, the rate of interest remains in that point only. Initially it remains over here only. Now what happened? The people are getting more money, they have more money in their hand because the money supply has increased, and they are thinking that they're going to, if they start investing more in bonds, they're going to get more interest rate. So ROI here we have said that we are talking of the bond price. Now rate of interest is more, so what they do, they try to invest, they start investing in bonds, hence the bond prices will go up as they started investing in bonds. So therefore the bond price will go up, and once the bond prices goes up, the rate of the interest declines. That is, this is how the increase in money supply leads to fall in the interest rate. You got the point? That only it has been written over here, that how the increase in money supply leads to fall in rate of interest. With initial equilibrium at OR, when the money supply is expanded from ON to N dash, there emerges excess supply of money at the initial OR rate of interest. So people would react to this excess quantity of money supplied by the buying bonds. As a result, the bond prices will go up, which implies the rate of interest decline. This is how the increase in money supply leads to fall in the rate of interest. Okay, got it? So this is very important, the Higgs-Hansen synthesized IS-LM curve model. What it has been said, there are two renowned economists, Sir John Richard Higgs and Alvin Hansen. They were the two economists. They brought a synthesis between the classical and the Keynes theory of interest. So there are two theories, one is classical theory and another Keynes theory of interest. In classical theory, they were able to, so the IS curve comes from the classical theory and the LM curve comes from the liquidity preference theory, from the Keynes liquidity preference theory. Okay, now determination of theory of interest through this two economists, Higgs and Hansen, they tried to bring a new theory of the rate of interest, new theories of interest from by intersecting the two curves, IS and the LM curve. Okay, so first we have to understand how the IS curve is determined, how the LM curve is determined. IS, you have to remember that I stands for the investment and S for the saving, and L is for the liquidity preference, or M is the monetary. So through derivation, the IS curve come from the classical theory and the LM from the Keynes liquidity preference theory. They have brought about a synthesis between the classical and Keynes theory of interest to provide an adequate and determined theory of rate of interest. So what it has been said, the IS curve tells us what will the various rate of interest at different level of income given the investment demand curve and family of savings curve at different level of income. And LM curve is obtained from the family of liquidity preference curves corresponding to various income level together with a given stock of money supply. So I will make you understand what is IS curve, what is LM curve, how they are determined. You just give reading these lines, you will be able to understand that what they state about. Higgs and Hansen show that with the intersection of the IS and LM curve, both the interest and the income are simultaneously determined. Okay, now derivation of the IS curve. So as we can see, the IS graph, it is sloping downwards. Okay, here it is the rate of interest over on the y-axis, saving and investment in the x-axis. Here ROI, you have to understand, here rate of interest means the rate of interest which bank charges. Okay, now for example, these are like all the in different level of income, the rate of interest, or we have to make the points and we have drawn the curve. Okay, so it's sloping downward. If you try to understand what it is, you will understand through a small graph I have drawn over here. You can see the ROI is in the y-axis and the investment is in the x-axis. Now what happens is that at R0 rate of interest, the investment is over here, and when the rate of interest is decreasing, the investment is getting to I2. So what is actually happening is that here ROI means the rate of interest which bank charges. Now for example, if the rate of interest reduces, like for housing loan, if the rate of interest gets reduced from 10 to 8%, then obviously people will take more housing loan and hence investment is done more. So therefore once the rate of interest is decreasing, the investment is increasing. For that reason, I1 is getting shifted rightwards towards the I2. So this is what it has been explained in this IS curve, that if the rate of interest decreases, then the investment increases. And as the investment increases in the market, the national income also increases. Okay, that only it has been given in the first para. If you start reading, you will be able to understand that once the investment is increasing, the national income is also, as each person started investing, and therefore the national income, it helps in improving the national income. So the national income is also increasing. Here it has also been said that the steepness of the ice curve depends upon the elasticity or the sensitiveness. Okay, how it is, so I will make you understand. Like, see, this is the ice curve. Here in the y-axis ROI and the investment in the x-axis. Now this curve is steeper. So here when the rate of interest is over here, the investment is done, investment is coming to I1, and when the rate of interest is reducing, it is coming to I2. So the difference is not so much. But if the curve is less steeper, means if it is flattened more, as you can see, then you can see there is a high changes in the investment. Not only it has been said over here that ice curve depends upon the elasticity or sensitiveness or investment demand change in rate. If the investment demand is highly elastic, that is very sensitive to changes in rate of interest, a given change in interest will produce a large change in investment and thereby cause a large change in the level of income. You just give a reading, you will be able to answer. That's when investment demand is greatly elastic or highly sensitive. The rate of interest ice curve will be flat, less steep. On the other hand, when the investment demand is not very sensitive. Now the next para I will make you understand what it has said. For example, I will make you understand one example. Like, if the government has made a road of 100 crore, he got a project of 100 crore and of making a road. So to make a road, he has given employment to 100 of pupils. So from there we are getting an income generation is taking place. Okay, for maintenance of the road, employment is given to the pupil, and then for the as the road has now the mobility increases, people take less time to travel. So for that reason also it helps so in this way it is helping the economy. It is acting as a multiplier. Therefore as it is helping in different way, the government has helped us in the different way, so it acting as a multiplier. Now what happens in autonomous investment, what it has been said over here, like autonomous expenditure such as government expenditure, which does not depend on rate of income or level of income. Like, private sector will not go to make a road in hilly areas of northeast, so the government only have to make, they have to make investment. So it is called the autonomous expenditure or the investment, as you can say. So due to this government investment, there is a rightward shift in the ice curve, which is called as a multiplier. Means it is giving income, it is giving income to so lot of people. So for that reason it is acting as a multiplier, and hence that only it has been said that autonomous investment, the government investment, sometimes act as a it helps in to give the rightward shift in the ice curve. In the ice curve, there it helps in moving, means rightward shift. It helps in giving the rightward shift in the ice curve for the autonomous investment. Expenditure or any type of autonomous expenditure increases, it will increase the equilibrium level of income and a given rate of interest. This curve will shift to the right. That only it has been said, because it is acting as a multiplier, as it is helping in the giving income to so lot of pupils, and therefore it helps in moving from the curve from towards the right, or the reduction in the government expenditure, the ice curve will move towards the left. So you got what has been said in the ice curve, how we are going to understand it. And then comes the LM curve. What happens in how the LM curve is derived. So the next comes how the LM curve is derived. Okay, so we have known from the Keynes liquidity preference theory that demand of money takes place for two reasons. One is transaction motive, another is speculative motive. So what means transaction motive? Like, when the level of income increases, transaction also increases, the transaction motive increases. And in case of speculative motive, what it happens when the speculative motive means investment in share markets or bond prices. So therefore the demand of money happens because of these two reasons. One is transaction motive, another is speculative motive. Now the demand of money also happens, also depends on the interest. If in the bank, if you are getting more interest rate, so they keep less money for transaction motive. For that reason also the money demand takes place, demand of money happens. So now so in the graph it has been shown, in the y-axis it is rate of interest, and here it is the amount of money in the x-axis. LP1, LP2, LP3, LP4, LP5, these are all the money demand curve. So we have seen that as the income increases, the demand of money also increases. Okay, so as the demand of the money increases, the curves are moving upwards, the demand of the money increases, and to keep in the equilibrium, the rate of interest are also increasing. So as the income increases, money demand also increases. For that reason it is the demand curve is it's moving up from LP1 to LP2. As the money income level increases from LP1 to LP2, the rate of interest is also increasing from R1 to R2 by the central bank to keep the market in the equilibrium. Now this graph, the downward graph, how it has been determined, I will tell you from this graph only. Now if we extend this line, and we stop it at this point, why I am stopping in this point I will tell you later on. R2 we have extended this line and we have stopped in Y1, and then R3 again we have extended and we have stopped the line in Y2. And if we join these points, here comes the LM curve. Now why we are stopping this point is like, this is LP1 demand curve. For Y0 income, the rate of interest is R1. For Y1 income, when the income is increasing, hence the curve is also increasing, the demand curve is increasing, and the rate of interest is also increasing. For that reason we have stopped over Y0, Y1, and in this way we have increased, because with the income we knew, as the income increases, with the income the rate of interest increases. Okay, so therefore the LM curve, it is sloping upwards. From this way the LM curve is determined. You got this? This only it has been written over here in this whole page, which you are seeing in this whole page. This is only written. Okay, whatever I have explained in the graph, you just give a reading, then you will be able to understand. So hence we are coming to the main graph, Hicks and Hansen main graph, which there is the ICE curve and the LM curve. Here it is the intersection point, national income in the x-axis, rate of interest. So here, so therefore we come to know this, the theory of interest depends on the 4 factors. What are the 4 factors? One is the investment demand function, I stands for investment, S for savings function. So investment, savings. 3 is the liquidity, L stands for liquidity preference function, and M for the quantity of money. Okay, so you have to remember investment, savings, liquidity, and monetary. These are the 4 factors for which the theory of interest depends. So what Keynes was not able to determine, the Hicks and Hansen, with the help of Keynes and ICE theory, with the classical theory and the Keynes theory, they determined that the theory of the rate of the interest, the theory of interest or the rate of the interest depends on these 4 factors. Okay, so this only has been written. These 4 factors, it is given 1, 2, 3, 4. So therefore hence we have ended with this chapter. So we will go with the check your progress, pick the odd one out. So we have said all this rent, wages, rent, interest, wages, these are all the income. Money doesn't comes in this income. Then comes the, according to G.M. Keynes, rate of interest and bond prices are inversely related. Keynes explained the interest in the terms of purely monetary forces. Okay, initially LM stands for liquidity preference and money supply equilibrium. ICE curve is derived from classical theory and LM curve is derived from Keynesian liquidity preference theory of interest. Okay, so thank you for watching.